Live. Ready.
Okay, hello everyone. This is Kathy Lien. Thank you so much for joining me today in our Market Outlook Trading Strategy webinar. I'm very, very excited to be speaking to all of you today, and we've got a lot to cover in the next 45 minutes. So let's get this kicking right away. All right. So before I begin, I want to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, please pause the screen, read through the disclaimer thoroughly before moving forward. So what are we going to talk about today? Today we're going to talk about the themes that set the stage for 2020, some of the biggest risks and opportunities, some of the outlook for the major currencies, as well as the general market outlook. So to kick off, there's been three key themes of 2019, and as we wash away 2019 and head into 2020, it's important to kind of review these themes because these are the same themes that in many ways will affect trading in the year ahead. So in 2019, one of the biggest stories was the rate cutting frenzy. We had interest rate cuts by central banks around the world. The Federal Reserve, for example, cut interest rates 75 basis points. They've got a meeting today. They are not expected to change interest rates, but guidance remains key. The Reserve Bank of Australia also lowered interest rates by 75 basis points, and the Reserve Bank of New Zealand matched that move. The difference is that the Reserve Bank of New Zealand lowered interest rates mostly in the beginning of the year, and the Reserve Bank of Australia kind of spaced out their rate cuts throughout a longer period in the year. There were bank reserve rate changes by the ECB. They also started QE interest rates there. There really is no room to cut interest rates, which is why they haven't done much. But they still felt like the situation in 2019 was serious enough that it warranted some type of accommodative measures. The central banks that made no changes were the Bank of England, the Bank of Canada, the Bank of Japan, and the Swiss National Bank. Now, this is very interesting because as we begin 2020, some of these central banks, like the Bank of England, the Bank of Japan, the Bank of England and the Bank of Canada may want to lower interest rates in 2020. So rate cuts and the possibility of further moves is still very much in the forefront of everyone's minds. And when it comes to currency movements, it's important to realize that it is that when you have divergences where certain central banks are doing something, certain central banks aren't, that can lead to a much more dramatic move in currencies. And that's something that we're very cognizant of as we head into 2020. The other big theme in 2019 is that last year, volatility hit record lows. This is the 3-month volatility of the euro. So volatility hit record lows, and this was kind of mirrored in the volatility of the VIX. It is this low volatility that allowed for the record-breaking moves that we saw in stocks last year. But as you may know, things have changed quickly and dramatically as we kicked off 2020 as a result of the Wuhan virus. So VIX has come up, euro has fallen, euro volatility has increased, and we are in a situation where we're moving away from the previous range, where we had gone from basically a 13-cent range in 2018 to only a 7-cent range in 2020 in the euro. Now, the year has just kicked off, and we haven't necessarily seen the really big moves, but in the first month and change of 2020, we have already seen a 250-point range in one direction in the euro. And that direction is obviously to the downside, with the euro, falling quite a bit over the past month. And then the third theme is policy uncertainty, where we had the trade war, Brexit, political chaos in Hong Kong, and the Trump impeachment. These were all things that factored into the market movements that basically, created a situation where investors, were very nervous. They were very uncertain about, what was going to transpire. And that uncertainty led to, more restrictive investments and was, really the big stories of 2019. As we head into 2020, in many ways, these stories remain in place. Phase 1 of the U.S.-China trade deal was signed, but what about Phase 2? Also, today, President Trump threatened, tariffs on the EU. We still have political chaos in Hong Kong, and we're still deep into Trump's impeachment hearings. So all of this will remain drivers of Forex and financial market trade in 2020. With that said, though, there are 5 key themes this year that will have a larger than expected impact on market movements. The first one is obviously the one that we're deep into right now, which is the global health crisis, the Wuhan virus, coronavirus. And there's a Malaysian, there's a well-known Malaysian saying where we basically escaped from a crocodile's mouth into a tiger's mouth. And what that really means is that we narrowly escaped the escalation of a trade war between the world's 2 largest economies. But now we're in, we're stuck in the outbreak of a deadly virus that's, worse than SARS, that, the world, the market, everyone has been ill prepared for. And so the contagion in this virus is something that's very serious. We've got the World Health Organization, delivering a, kind of emergency call on Thursday to kind of detail us on, what's going on and whether they, think that there should be more restrictions as a result of this. But what we do know is that first and foremost, the virus has not peaked. And the virus contagion has not peaked. The trajectory of the cases in mainland China and internationally, and the number of deaths that have been associated with it have just skyrocketed on a near daily basis. And that's the, officially reported numbers. The unofficial numbers are probably even more severe. As the number of cases exceeds 6,000 in China. It's probably in the tens of thousands, if not 50,000 in reality. They're reporting only 6,000, but it's definitely going to be worse. It's definitely worse than that, and it's already eclipsed the total number of SARS cases that China reported. It's going global. We have cases reported throughout Asia, in the north, in the south, in Canada, the U.S., France. This is an old chart. Germany also has cases. So cases in widespread. And what's terrible about all of this is that a lot of the people coming out of the Wuhan province are trying to evade the temperature checks by taking temperature reducers, and they're passing the checks and then going into these different countries and infecting more people. It's terrible. But what we're all really worried about is the economic impact. So what some people have described this contagion as is a low probability, high risk event, which means that yes, it's spreading. But in the US, the number of cases are still very, very limited. And so there are cases spreading, but the risk of it becoming a global epidemic where we all have to hunker down and stay at home and don't go anywhere, across the globe, is very low probability. But if it gets to that situation, then it becomes a very high risk. Regardless, this just shows you, the next few charts will show you kind of the economic impact of SARS as and that can give us an example of what the possible economic impact of coronavirus is. So SARS was back in 2003, for those of you that remembered it. The World Health Organization, this is a chart of the commodity price index. So the World Health Organization first issued its SARS alert in March, and they said that the world should be SARS-free in mid-June. So during this period, we first had a very huge decline in commodity prices. And so things remained depressed for about 2 months. And then as it started to fade from the world's minds, then we saw recovery. I mean, we're only about 2 weeks, 3 weeks, 2 weeks into this whole pandemic. And so we're at the very cusp of the losses. And if it doesn't become a global contagion and it does get contained, it's going to fade in people's minds before the World Health Organization actually says that the world is coronavirus free. So that's why you see a recovery before the actual official announcement. But it is quite a steep decline in commodities. In terms of equity movements, people say that SARS had a limited effect on Chinese equities. Now, SARS is very different from the coronavirus in the sense that SARS was much more contained in Asia. And the coronavirus, the cases reported abroad were far more limited, and there was less media focus on it in terms of domestic exposure. But that's not the case with the coronavirus. So the yellow line here shows how the world equity indices performed. The red line shows how the Chinese indices perform. And what you see here is that in March, yes, Chinese stocks collapsed. And even though it recovered, it then continued to collapse and didn't bottom until April. Global indices also collapsed a little later than Chinese markets, bottomed out much sooner, and then just completely forgot about the issue and moved on. Now, the other situation that is different now than in 2003 is that we were at record highs in U.S. stocks. So we were at record highs, and as a result, investors are looking for an excuse to take profits, to liquidate, to reduce their positions. And the coronavirus could very much be the excuse. The impact of SARS on GDP. In Asia, quite significant. In Hong Kong, much more so than China. China had about 1% GDP impact. Hong Kong had a 2.5% GDP impact. The other countries also were impacted in Asia, like Taiwan and Singapore. The global impact was not as significant. These are in billions of dollars on the right-hand side as opposed to percent. And so while we did have a significant impact in China, and China adding on to everyone else obviously gives us a larger world bar. If you look at the U.S. and Canada, and even Singapore, the impact was less. But as I said earlier, this it is already more severe than SARS. And so the toll on China and the toll on the rest of the world is going to be far more significant as well. This is a chart of consumer spending in China during the SARS outbreak. And you can see where the gray shaded line is, that there was very much a significant drop in consumer spending in China. And it's going to be much more the case this time around, not only because this is happening, or this happened right before the Chinese New Year, where people normally, share red pockets, use that money to spend, go out on vacations, and then also spend more money as a result. There's usually a lot of consumption that happens around this time, and that's just not the case. I mean, the Chinese, you've got Starbucks shutting down more than half of their stores, McDonald's doing the same. You've got, a lot of international businesses, taking different actions. It's a situation where this pullback in spending is most certainly going to be deeper than what you saw here, and maybe even more everlasting. It's obviously a little bit difficult to tell. We'll see, but it could be more longer lasting. And so we're watching that, very closely. And, it's not just going to affect Chinese demand. It's all through Asia and also, possibly in other parts of the world as people kind of reduce their social interactions during this time. So the coronavirus is a huge, huge theme for the start of the year. I hope that this will not remain a risk to the markets come the second quarter, let alone the second half of the year. But for the first quarter, it's going to have a significant impact on demand. So as a result, even before all this happened, 2020 was expected to be a year of no recession, but little growth, where we don't get much in the way of activity, where most of the major countries, just kind of stagnate, where we don't really see significant growth. I mean, basically, these two tables show you how growth changed from 2018 to 2019, and for most countries, growth basically slowed. Like the U.S., the bottom of the chart went from 2.5 to 2.1. China went from 6.4 to 6. That number is going to be a lot lower in 2020. And so it'll be a year of very little growth and no recession. And this just shows, this is a heat map of manufacturing activity around the world. And you can see on the right-hand side that a lot of them are in very few greens. A lot of them are yellow and red, indicating that we're moving into a phase of, more contraction activity in manufacturing. And the coronavirus is going to hit manufacturing just as hard as it's going to hit the service sector. So we're going to see a lot more trouble ahead. So no recession, little growth will have a direct impact on monetary policy. Will it mean the end of monetary easing? That depends. That depends on how deep or how widespread the virus becomes. It depends on how significant the issue is. And it's really hard to say. But for the most part, certain central banks will have to put rate cuts back on the radar. Other central banks, like the Fed, where they meet today, is probably not going to acknowledge the impact of the coronavirus yet. And the reason for that is because it's too early to say. And they update their economic projections in March, so they could wait. They could wait to see, whether the contagion kind of dissipates or peaks in February, and if it does, then they really don't need to be as concerned. But if it gets worse and worse, then they may have to make some downward adjustments to the economic projections. But we are, regardless, at the tail end of monetary easing. I don't expect the coronavirus to be front page headlines in a month, 6 weeks. I really hope it won't be. And at that point, central banks can move on. And when we're in a period where we have the end of monetary easing, that returns carry. And what carry is basically buying currencies with high interest rates and funding them with currencies of low interest rates. And it usually coincides with kind of a risk-on environment for investors. So we could be in a situation where emerging market currencies, emerging market asset classes outperform because they, first of all, like a country like Mexico, they're far less exposed to the coronavirus than Thailand or Malaysia. And so those investments and bonds could be more attractive. And if central banks really aren't, cutting interest rates anymore, at least not the major ones, we could see a return of the carry trades, at least slowly. At the end of the day, though, the Fed controls all. And it's all about what Jay Powell says or does. And this shows you how, the Fed and their easy monetary policy has driven this massive rise in equities. Now, stocks are beginning to peak, and they're beginning to, pull back. And there could be a deeper side because, the earnings impact of the coronavirus could be quite significant. So then it'll be up to the Fed. Do they keep the party going? Do they leave liquidity as flush as they have over the past year? Do they hint of the possibility of more stimulus? All of that plays into the question of whether carry will return. I think, the Fed is going to, is going to do exactly what they say, which is that the monetary policy will remain unchanged and easy for the foreseeable future. And I think that's something, they are working very, very hard to maintain in order to avoid any sort of shocks to the economy. And unfortunately, we have exogenous shocks right now in the form of all of this all of this contagion. And so they need to maintain easy monetary policy as a result. They also can't control have no idea what, President Trump is going to do. Trump or dump. This is also an election year in the U.S. And Trump and Trump's policies have had a dramatic impact on the global economy, from his protectionism to his trade wars, sanctions, actual wars, or at least military action with Iran, and the way he's approached other countries. In his 4 years, he has transformed America's relationship with other countries, and also directly affected and taken out of the control of the hands of those governments, how their economies are doing. So another 4 years of Trump would have dramatic impact on the financial markets. And it's, and a lot could happen between now and the November elections, because Trump knows that he's only the third ever president to get impeached. And he knows that he already has that against them. If stocks collapse before the November election, it's going to be almost impossible for him to get reelected. So most likely, he will do everything in his power to drive up stocks, boost the economy before the November elections. And that could be in the form of promising phase 2, promising another tax cut. All of that is very favorable for risk appetite, very favorable for stocks. And of course, he'll drive up unfavorable ratings of his Democratic rivals and maybe even start another war. These are all risks that the upcoming election poses, because we have the U.S. is such a hot-headed president. But the real way that he's going to get reelected is, of course, the economy. And that's going to be his main focus. And that's really going to be, how he gets, he feels like is in his control. So where's the opportunity? Politics aside, taking a look at how currencies perform in election years, there's one distinct pattern, which is that the U.S. dollar tends to do very well during an election year. We've already seen that now. Now, of course, for different reasons, because of risk aversion driving investors into the dollar as a result of the coronavirus. But the U.S. dollar has already performed well. In the last 11 elections, the dollar index has risen in 9 of those elections. In the last 11 elections, the euro has fallen 9 out of 11 years, and it's already falling now. So what does this tell you in terms of trading opportunity? What this tells you is that it's probably smarter to focus on long dollar trades this year than short dollar ones. If you get a signal to sell US dollars, maybe underweight those positions, and maybe focus, and or maybe pass on it. So that's basically how you can use this information to your advantage. There's no pattern really in equities or gold, so in an election year, so it's really not much we can garner from that. The fifth theme is gold. Gold's at a 7-year high and will probably rise further due to political risks, this health crisis, the potential for a deep correction in U.S. stocks, deficit spending, the Fed balance sheet expansion, and pretty much non-existent inflation. All of that is good for gold, making gold, a pretty interesting opportunity this year. Taking a look at some of the regional some more specific currencies, let's talk about what's ahead for Europe. For the most part, despite the euro's weakness, I believe that the worst is over for the Eurozone. Brighter times lie ahead. Germany avoided a technical recession last year. European politics are not expected to make anything worse. The elections that we have in the Eurozone is probably going to basically lead to status quo. The migration crisis has peaked. Populism performed poorly this summer, so it's not really too much of a risk. And one of the most important things that we've learned is that Brexit is survivable. It's not as much of an issue as the market had been worried about in 2019. But there are two opposing forces at hand. ECB President Lagarde has been pushing individual governments to increase stimulus because they don't think that their economic condition, because they want these governments to do their part. They want these governments to basically come in and provide fiscal stimulus because they are running out of room on the monetary side. But all last year, Angela Merkel resisted calls to increase stimulus because they did not feel that economic conditions warranted such a rushed fiscal response. That has proven to be valid because we obviously saw that Germany avoided recession. But even so, even though it may have been valid, they're saving their ammunition for a more challenging time, and this, or possibly what this whole coronavirus turns into, could very much be that. So definitely be careful because fiscal stimulus could be on its way. In general, for our expectations for the economy, we expect low inflation, low growth, and low employment. So not expecting much from the Eurozone. But still, it seems like the Eurozone is outperforming its peers as most data more data surprises to the upside than the downside. So that could present itself as an opportunity as well. And in other words, what I'm trying to say is that the euro is likely to be a buy on dips than a sell on rallies this year. What's ahead for Australia, New Zealand, and Canada? There's the broken trust between the U.S. and China, and there's Mother Nature, which now we can include the coronavirus in the story of Mother Nature. And, they basically pose, ongoing risks for Australia and New Zealand in particular. So I think that, we could very much be in a situation where we see Australia, the Australian and New Zealand dollars, which has already fallen to its lowest levels in 7 months, basically get worse. And we could see that the currencies, in 7 weeks, fall even further. So we're looking for export values to fall, growth to slow in Australia, inflation to weaken. Next week, we have a Reserve Bank of Australia rate decision. The CPI numbers that we had yesterday kind of removes the chance of a rate cut next week, but it's going to be on the table, and they're going to get much more serious about it, much more worried about how their economy is doing. In New Zealand, the good thing about New Zealand is they've got infrastructure spending to support the economy, but the government's already cut 2019-2020 growth, and it's probably going to be even weaker. Inflation's on target, but there's scope for another 2020 rate cut. For the UK, Brexit means friction. The Brexit is happening. We have certainty on that front, but we've got border. But now that the agreement's been made and they're going to leave the European Union, this departure leads to border and trade friction, travel and work friction, market friction, and what friction means and what friction creates is that friction creates higher costs and less output, which could lead to a situation and where we see a further slowdown in the UK economy. So with that, I want to move. So with that, kind of synopsis, you've got my outlook for the global economy and for 2020. Now let's talk trading and trading strategies. So how can you find big Forex trades in 5 minutes a day? If you've ever followed my work, you will know that hands down, my favorite trading indicator, technical indicator, is double Bollinger Bands. And double Bollinger Bands are really wonderful because they provide us with such a wealth of information as well as actionable trading setups. So, how do you set up your Bollinger Bands? Typically, whenever you have Bollinger Bands in your charts, you always get the second standard deviation Bollinger Band, which is the outside line. What I've added on here is the first standard deviation Bollinger Band. And what this does is it basically, the Bollinger Bands basically help us identify good points to pick tops and bottoms. So if you use Bollinger Bands on a classic basis, the way they're designed to be used, the whole idea is that if the price touches the outer line, which is the outer line, the Bollinger Band, it's considered overbought, so sell. If it touches the lower line, it's considered oversold, so buy. But that is not necessarily the most effective way to use Bollinger Bands. Give me 1 second. The most effective way to use Bollinger Bands is to wrap around another set of Bollinger Bands, hence creating the double Bollinger Band, where you have an outside line and inside line. And the reason why it's not so effective is because currencies can oftentimes become very, very overbought or very, very oversold. And that could be an environment like now where you have fear, creating an environment where just sell. And if you keep buying as it touches the lower Bollinger Band, then you'll be hit with loser. So by wrapping in the first standard deviation Bollinger Band in the middle, that creates a really valuable filter. And what this filter does is that it gives you a position to wait. So instead of selling as soon as it touches if you start with the left-hand side of the chart, instead of selling as soon as it touches the second standard deviation Bollinger Band, you wait for the currency to close below the first standard deviation Bollinger Band, and then you sell. So let's wrap some rules around this. So first, you want to look for a close below the first standard deviation Bollinger Band, which is the inner line in this case. This is what it looks like. You wait for the close below the first standard deviation Bollinger Band where my blue arrow is pointing. If you see the close below the first standard deviation Bollinger Band, then sell at the next candle. And this is on daily charts. So you short here, short, you put your stop, in this case, because we're in a short trade, at the swing high, which is 30 pips above the first standard deviation Bollinger Band, whichever is smaller. So our stop here is 30 pips above the first standard deviation Bollinger Band. We're trading daily charts. Target 1 times risk, move stop to break even, and then trail your stop on the remainder of the position. So what we're looking at here is we're basically looking at the currency closing below the first standard deviation Bollinger Band. You sell, and unfortunately it's a big candle, so the risk is larger than we would like. It's a big candle, we short, stop, back above the first standard deviation Bollinger Band. Because if it goes back above the first standard deviation Bollinger Band, you're wrong. The reversal is already happening. And yes, this is daily charts. You close below the first standard deviation Bollinger Band. And you target 1 times risk. This is obviously a big move, 178 pips. So you target 1 times risk. When it moves to 1 times risk, move your stop to break even, and then trail your stop on the remainder of the position. Here's another example to the long side, where you basically see the currency close above the first standard deviation Bollinger Band. You go long with the stop 30 pips below, and then you target 1 times risk, and these are big moves because these are daily charts. So these are big moves. You target 1 times risk, and in this case, if you trailed your stop, you may be able to capture, much more of the position. Double Bollinger Bands can also be used to enter an existing trend, which may be very valuable right now because we're already seeing the decline. We're already seeing broad-based sell-off. So what's the right point to enter? I mean, that's going to be a very tricky question for most people, which is what point is the right point to enter? So the Bollinger Bands can help you do that. And what you'll notice is that when we are basically in the 1-2 band, the downside, we call this the quote-unquote sell zone. If we are in the 1-2 band on the top side, we call it quote-unquote buy zone. And so when it's in the buy zone, it will, like in this, in this case, it's in the sell zone. It will retrace back to the first standard deviation Bollinger Band. And when it retraces back to the first standard deviation Bollinger Band, that could be a point of entry, a buy point. So let's go ahead and wrap some rules around this as well. So what you want to do is you want to place a limit order to sell at 1 standard deviation Bollinger Band in a downtrend. So you want to basically you want to place your order, and you can just reset your order every day at the first standard deviation Bollinger Band. And then you place your stop 35 pips above the first standard deviation Bollinger Band. And so you go short. Usually in this case, the stops are very tight because you're just looking for the retrace to hold. You target 1 times risk, move your stop to break even, and trail your stop on the remainder of the position. So what you do here is that we sold here, and because we only have a 35 pip target in the first half, it gets hit relatively easily. And in this case, our break-even stop was triggered. But in some other cases, you may be able to get more. It becomes a deeper trend. But the bottom line is that it gives you a smarter place of entry, a better place to enter the position. So we talked market outlook. We talked trading strategies. How can you combine them? How can you turn market outlook into trading opportunities? And how can you do that on an intraday basis? Because the Bollinger Bands are great, but you only get a trade once every few months. And one really good way to do it is to use, and the way I help our members do it, is to use a combination of our heat map as well as our zip trader trading indicator. So every few days for our members, I will update my view on the markets. I may say I'm dollar bearish, or I'm euro bullish. I may say I'm pound bearish or Aussie bullish. I'll show you the most recent one right over here. Sorry, where we basically have my heat map, and I will illustrate to you. These are our current views. I'll let that load in a minute. And so, when we see a signal in the direction of our view, that's what we want to take. So this is our zip trader indicator. And the way it works is that when the currency crosses the indicator line and the background is green. So if you see a green cross and the background is green, that's a signal to buy. If you see a cross of the indicator line and the indicator from above the line to below the line, and it's red, and the background is red, then it's a signal to sell. However, taking those trades blindly obviously won't work. You want to filter it with the heat map. So in this case, in mid-January, if you went to the heat map, you'll see that we were euro bullish, Kiwi neutral. So we're only looking to trade euro Kiwi on the long side. So we avoided all the short signals, all the false signals, and we went long euro Kiwi to the long side when we got the cross above the indicator line and the background was shaded green, and we turned to the heat map and we saw that we were euro bullish, Kiwi neutral. That was the confirmation to take the trade. So for example, lately, this is the latest one that was updated on the 27th, and you can actually sort by this. One of the trades that we took last night was Kiwi yen short. And the reason for that is, let me turn to Kiwi yen, is last night I got the red candle. And over here, we got the red candle too before the gap open on Sunday. So the currency crossed below the indicator line, and it crossed to the downside. And I turned to my heat map, or our members turn to our heat map. You sort by Kiwi yen, and I give the reasons for my rationale. You can read it yourself. You'll see that I was bearish Kiwi, bullish yen. And so that told you that on a technical basis, you got the signal to sell Kiwi yen. And on the fundamental basis, you had the heat map basically supporting the trade. So it just shows you how to combine the macro outlook with the trading opportunity. Another setup that we had was actually Euro Aussie, where just to show you the power of the heat map. We had a signal here, and it doesn't look it's a big move, but our initial target was close enough that it was a close enough move for it to be meaningful. And that was enough, to basically give us a nice entry into the trade. And just to show you other examples of this working, so you can see here I was neutral dollars, so it was fine to take this trade, and you had a very nice powerful move to the upside in dollar Swiss after we got the green candle. Kiwi dollar, there was no signal. Euro, I wasn't bearish euros, I was neutral euros, and we had a signal to sell the euro earlier today. Also very, very nice move to the downside. So that's basically how you can turn macro views into this trading opportunity. And it is how we basically use the combination of fundamentals and technicals to achieve our goal of 100 pips a week. For our members at BK Forex, my goal is to make 100 pips a week, 400 pips a month, 3,000 to 4,000 pips a year. And so far, so good. In the last 3 weeks, in the first 3 weeks of the year, we are up 100 pips a week, and this week so far we're up 80 pips. And since August, we've made 1,647 pips. Of course, past performance is not indicative of future results, but we've got a very clear target, a very methodical way of approaching it with our heat map as well as our zip trader indicator. And so, we are on, this explains why we're doing such a good job of achieving our goal. Now, for everyone who is watching this presentation, I want to extend you a very, very special offer. For 48 hours only, I'm extending you the offer to become a member, try us out, see what we do, see how well we do it. We trade not just currencies, but also CFDs, indices, commodities. You can get all of that along with our 24-hour chat room for a discounted rate. It's only valid for 48 hours. And on top of all of that, you get 3 free courses on how to trade the euro, secret to trading the pound, yen, and Swiss, and the commodity trading course, which alone is worth $375. And you're getting all of that and our trading signals for only $145. So if you want the link, it's here. It's trading.bkforex.com 2020 special. I invite all of you to join me. It will be, it has been a great start to the year. It should be a great one overall. Now I'd like to open up the floor to questions. I had some questions earlier that I answered, which is, where do you see the euro? I see the euro higher, not lower. I think, we're probably near the bottom. Yes, the Bollinger Bands are traded in a daily chart. And could you explain the dollar index will strengthen in election year? That's the general behavior. Yes, my fundamental outlook is inconsistent with the historical trading pattern during election years. And maybe for that reason, it's better to just take the trades based upon where the heat map is, what the momentum and fundamental drivers are for that week in the currency to see if it's supportive. And basically, it's not as if you're going to buy the dollar now and just hold it and not trade it and not, basically move in and out of it until December. You're probably going to, buy, sell. So that's why it's much better to take that view into context and apply it to your trades on a more short-term basis. Any other questions? If you ever have any questions, you can feel free to email me at Kathy@bkforex.com. I'd be more than happy to answer it then. If not, I've got to go and live trade FOMC with our members. We do that every single week. We try to trade some of the biggest event risks. So FOMC is in 10 minutes. And so I've got to get them set up for our live FOMC trading session. Thank you so much for joining me. And as I said, feel free to email me if you have any questions. And I truly invite you to take advantage of this offer. We've been doing very well, and I think you'll really enjoy our service.